I've always believed in my investment strategies that volatility is life, and I have had a good run. Like in the last 10 years, I had roughly 45% of compound annual growth rate in my personal portfolio. And yeah, in this video, I want to share my philosophy generally, why I prefer to own first a volatile asset. This is unlike most people who don't want volatility, and second, an asset that lasts a long period of time. So this is like the perfect asset for me, is an asset that is highly volatile and that I'm sure will still exist in a decade, 2 decades, 100 years, right? And of course, one can always be wrong. This is not investment advice. You always need to leave a margin of error. So if you're completely wrong with any investment thesis, you should still be able to survive and like do all the things you want, right? And reach your goals. So you should always diversify. At least this is not financial advice. Nothing in the Finxter videos is. Okay, but let's dive right in. So I found a tool. It's about dollar cost averaging, and I think this is a perfect way. And we will simply look at different assets and look at like highly volatile and highly stable assets, and look at the returns it provided. And I try to add as little bias as I can into it. Okay, so let's have a 10-year track record. Sorry about that. Track record for different assets, right? And like a good strategy would be, for example, to diversify among those assets, doing a dollar cost averaging amount that you can afford monthly. And I've always done it like this, and then add it to different types of assets, and then just let them run, right? Okay, so here we have a dollar cost averaging approach. The good thing for dollar cost averaging is that you buy more if the asset is down. So volatility plays into your strategy, right? If the asset is down a lot, you would buy a lot, and you would get much better returns. So even if the asset is fixed over time, so maybe we can have a whiteboard. Okay, this doesn't allow us whiteboard. So let me just open Paint. So this is very high quality professional video. Okay, so if you have an asset, so this one is like your dollar return of the asset. This is the time you buy at certain intervals, like monthly, maybe $100 or so, right? And your overall purchasing sum would look like something like this, because you buy, like, it's a linear growth, right? You buy $100, say, every month. So over, like, after 4 months, you would have bought $400. And now, as your asset actually fluctuates here, right? So the more it fluctuates, the better, because now at these points here, and here, you would buy a lot of those assets, right? Bringing down your average purchasing price to, so if you have now, like maybe here you measure your average purchase price. If you buy the asset at the top, your average purchase price would be like this, right? If you buy the assets at the bottom, your average purchase price would be like this. If you buy, like, if you do a DCA strategy, you would expect that the average purchase price is this, right? Right in between the top and the bottom. But this is not the case, because with the DCA, your average purchase price is actually smaller than the average between top and bottom, right? Why is that? Because you would buy more. You would buy more at the point in time where the asset has fallen more, right? Because you have a fixed number of dollar units, and if the price has fallen more, say the Tesla share fell from $100 per share to $20 per share. Now at $20 per share, you would buy 5 shares, right? And if it rises again to $100 per share, you would buy only 1 share, right? So you have, in this scenario, you would have 5 shares for $100, for $20. Sorry about that. And 1 share for $100. So in two consecutive months, right? And if you add the weighted sum for this to calculate the average purchase price per share, you have like 6 shares for $200. So your average purchasing price is $33. And chances are that over time, your asset, especially if the asset stays alive for a long time at least, it could even be sideways volatile, right? This would be fine as well. Your average purchasing price would be below the asset price in most instances, and you would make some kind of profit. So dollar cost averaging into a volatile asset is not a risky strategy in my opinion. Good. Okay, so let's start with a simple bond ETF, for instance, and we will keep tracking it, right? We invest $100 monthly for a 10-year period, right? Now we recalculate. And as I said, you should probably never put all your assets into one asset class, or all your investments into one asset class. Here, if you had done dollar cost averaging in bonds, which is highly stable, it is not very volatile, then you would have like even like a negative return. I mean, bonds would have performed better in many other decades, but this is a decade, right? A decade of investment, and bonds would have performed negative. Your capital would be there for sitting there for a decade, but it would be negative. Okay, so bond you would have invested the same total return, total. Maybe not. Let's not call it a return. It's just the asset value, right? So the asset value is, the position is valued at 10,094. So let's put in 10,094 here. And what would we have invested in cash? So say we have 12 times 10. So this is the number of months times 100, right? So we would have invested 12,000. If you just let it in cash, it would remain the 12,000, right? If you invested in bonds, in the bond ETF, for instance, you would have done negative. So these are like the most stable two assets that exist. Let's have some more fun. Let's put it in Tesla stock. Tesla is a highly volatile asset, much more volatile than most stocks. And in this instance, we would have made 46,000 in gains with a position valued at 75,800. Okay, so let's put Tesla here. You would still have invested 12,000, but your position size would be 75,000. Okay, so it looks better. And you can also see here, we see the straight line is the sum we have invested, and for a long period, for a long period of time, we would have been underwater, but we would ultimately you come out with a gain. And there is some hindsight bias at play, I know, but this is like for all investments, we have hindsight bias at play. And that's why I say never put all your eggs in one basket. And the second, maybe it's not even that bad, right? Because now you see here, this top line is actually how much the position size, and actually after only 3 years of the dollar cost averaging strategy, you would have been in positive, right? That's why I say never put all your eggs in one basket, and also don't assume like that you know the one asset. Actually, it's a variant of the first rule. So let's just stick with the first rule. Never put all your eggs in one basket, right? You cannot predict it anyway. Okay, so this would be a volatile asset. Let's have another volatile asset that has performed much better. Tesla has not performed so well in the last 5 years. But even in the last 5 years, we would have made profit with Tesla. I checked before, with the dollar cost averaging strategy. Okay, so Nvidia would be like obviously a great. You would have like with a simple $100 a monthly basis, you would have made like 459,000 in gains, right? So this is insane. But of course, you would never have found Nvidia in 2014 if you wouldn't be a PhD in computer science. Okay, so 459,500. 459,500. Good. So what about some like more standard asset? I think we should include the S&P 500. S&P SPY. I think this is the most well-known S&P 500. We still have the 10-year period, recalculate. Now S&P 500 is much less volatile than these other assets we have just checked out. Yeah, you would have made much less gain, obviously, right? It's like 8,800, 500. So we have SPY, 12K, 8,500, something like this. With the position size. No, this is not. This would be the gains, right? No, I did a mistake. 20K, 20.5K. So we have 2,500. So nothing revolutionary, right? You would make much more investment if you have an investment vehicle that you believe in, that survives, and that is much more volatile, because volatility is your friend with dollar cost averaging. Okay, let's just for fun also have some BTC USD. Many have already came in contact with it 10 years ago and could have predicted this. I wasn't like in the space 10 years ago. So we have 593K with a position valued at 604K. So BTC USD 604,000. Okay, so now 604. This is just investing $100 per month, right? If you have like $500 per month or so, you could try out 5 different assets to have the best of all worlds, right? And yeah, but I just want to prove that volatility is our friend for investment. So we should use the volatility. This is the main takeaway of the video. We should try to leverage volatility with a well thought out dollar cost averaging strategy, and then go into highly volatile assets, because then the risk actually becomes very little, and most of the time we are in profit for most assets, even if they go sideways. So let's have a look at the sideways asset that was also volatile. Sideways asset volatile. Is there something? So this is something we could ask ChatGPT, right? So let's ask ChatGPT. That's 10 year. Let's see if it even understands the question. So it still tries to understand the question. Let me think, what asset was went sideways for 10 years? It was also very volatile. I don't know, maybe gold or something. Maybe real estate. No, real estate probably went up. Let's try one more thing. Try gold. Gold is not so volatile. It's more stable. It is more volatile than bonds though, right? So it should perform better than bonds, but maybe worse than S&P 500. Not sure. So gold would be positioned at 12,500. So we have gold at 12,500. Okay, so here you have it, and a good strategy. So if you invest, say, $100 in all of those every single month, say you are lucky and you can invest $700 per month. Many can. If you have a 6-figure job, or if you are an AI engineer. By the way, you could, if you want to learn how to be an AI engineer, then check out our newest course on the Finxter Academy. Just go to academy.finxter.com. Here's the URL. Type it in and you can join our most recent course. I have launched it yesterday about Hugging Face. This is such an awesome course. It's held by Dirk, who is an expert creator, expert prompt engineer, AI engineer. He's really great. He knows his stuff, and he did even like great things like dynamically creating music, like hip hop beats and so on his local machine, and he teaches you how to do it, right? Without like using Llama and the open source and free and open source software to generate text, images, speech, music on the local machine. This is really awesome stuff. So check out the course on the Finxter Academy. Good. And yeah, if you had invested like $100 in all of them over a 10-year period because you couldn't decide, then you would the sum would be 1,193,000. So you would have become a millionaire just with this very conservative strategy, right? And yeah, if you do it with 10 different assets or 7 different assets or so, then there will be a few breakout successes, especially if you choose volatile assets, right? There will be some breakout successes and some failures, but the failures will still recoup your initial investment more or less. But if you are in a too stable asset like bonds or so with almost no fluctuation, often the risk is higher in my opinion, because you cannot buy at low prices using the strategic dollar cost average strategy. So volatility is life. Don't shy away of volatility is the main takeaway of this video. Thanks for watching this video. Give me a like and subscribe if you want to stay tuned with our content, and see you in the next video. Bye.